Good morning and welcome to Almus Market Mornings. It's good to be back, though I'll admit the markets guy in me missed the volatility. The key story today is President Trump's push to pass his budget bill, which could add to US debt levels if approved. While US yields remain elevated, the real action is in Japan, where a weak bond auction and reduced central bank buying has sent 20-year yields sharply higher, raising fresh concerns. Gold broke out to 3315 yesterday before cooling off, and oil is trending higher too. JK, Japan's bond market turmoil looks serious. Can you break down what's driving this and how markets are reading it?
Hi, good morning, Swaraj. Yes, I think overall it's a overall scenario of bond market turmoil that is building up. Of course, we all know US has this twin problem of high deficit and high debt, and even as that is not addressed, the new budget bill which the Republicans are trying uh, to pass has no indications of an attempt to reduce the deficit. On the contrary, the tax cuts which Trump 1.0 had introduced will be reintroduced, and with no major spending cuts, the expectation is that it will result in adding to the debt by nearly 4 trillion in the next 2 to 3 years. That excludes the interest payments as well, and this is not something the market is going to take kindly, and they have not taken it kindly as well. We saw the 30-year trade 5.03% in US, uh, which was last traded in October 2023, and 10-year crossed 4.5. Both of them slipped back, but they're very close to those levels again. And see, there is no reason to think that these will pull back, very swiftly, because even as the US data continues to be somewhat mediocre, it's not warranting any major action by the Fed, and the uncertainty about the inflation driven by the tariff continues. In fact, one of the Fed members yesterday actually hinted at a period of stagflation, and that's not a good news. So this is having a ripple effect on all the markets. In Japan, of course, they have their own problem. Recent Japanese GDP growth was minus 0.7%. It was a shocker, then raising concerns that Japan government has to do more on the fiscal. Again, fiscal spending means that there will be pressure on rates, once again, market borrowing and all that. So at the same time, Japan is not doing the QE as much as they used to do. So there had been a failed auction twice this week, and there's one more that is slated for tomorrow. The investors are not really keen on buying into the JGB's long end yields, and Japanese 30-year bond yield has hit a new all-time high. And so the sentiment is very poor. It's not just confined to Japan; it's also from US. We also know that Europe itself is also planning to spend a lot of money on infrastructure and development, also defense. So there again, they have got the debt break. The German government has got a debt break to freely spend up to 1 trillion euros. So again, the resources where this will be found only from the market, and so there is a general pressure on fiscal side to borrow more money, and leading to higher yields. And US is of course in the most critical point. And the latest move by Moody's, although the rating downgrade was in line with what other agencies had already done, the timing indicates that probably US is now at a tipping point. So the experts believe that a 5% break on 30-year will eventually happen on a sustained basis, and we move towards 5.20, and perhaps the 10-year will move towards 4.70 as well. And with no rate cuts on the horizon, which is now down to expectation of only one, perhaps in September or in December, I think the way for bond yields are only one way. I think it is up. So this is the background. on which Japanese yields are also going up, and yields are going up gradually everywhere. Also in India, also it is found very good support at the lower level, and there has been small outflows from the bond market as well, even from India. While all this is happening, we also have an ongoing G7 meeting where, of course, the focus is on, as per that stated agenda, it's on the global economy, economic security, resilience, situation in Ukraine, financial crime, and artificial intelligence. But while all this will be the headlines, there will be sidelines on the sidelines talks about how the nations are going to approach the U.S. Tariff moves, and how the U.S. themselves are going to, convince other countries to weaken their currencies, which is not openly stated, but definitely some push is there, particularly towards Japan. And Japanese officials are repeatedly making statements that swift moves in the currency will be destabilizing, and they want rates to be market determined, etc. This is another point of pain for Japan if there is a push for stronger yen by the U.S. authorities in in return for the tariffs being reduced. That will be again one more pressure on the Japanese economy. So all this are actually leading to some sort of a subdued risk sentiment in the market. U.S. markets were again yesterday somewhat on the weaker side. We saw other Asian markets also somewhat giving up their gains. This is all despite the fact that Australian central bank cut the rate. This is one of the you know you can say unassuming event that did not really have an impact on the market, stock market. Of course, Australian dollar weakened a bit more because the central bank said there can be more cuts going forward. So on the currencies, dollar definitely displaying a tendency to weaken once again. Although because of the big short positions initiated in a very short period of time, the rally could take rally in other currencies could take some time, but the ongoing sentiment among the market participants to reduce their overall exposure to the U.S. assets, and the push for a weaker dollar in some way or the other by the U.S. administration will keep the dollar on the weaker side. Maybe the rally in other currencies or the fall in the dollar will be gradual, but definitely the underlying direction is very clear. We could see some discussion among the members on the sidelines of the G7 also, which could reflect in the prices going forward. Yes, as you said, there has been a big rally in gold. Of course, it's a part of a broad precious market rally that we have seen. Gold rose 2%, silver 2.2%, but platinum and palladium, which have been sleeping for quite some time, have risen more than 6% in this week. So gold, of course, saw some stop loss driven buying after 3250 was broken. I think the short-term traders had been running big short positions, and those have been cleared out now. Silver also has been in a still in a range, of course, 32 and 34, but there is a good technical setup for a rally beyond 34, possibly hitting 35 near term. Now, palladium demand for platinum jewelry in China, which had declined recently over the past few years, has started to pick up. And there is some, I think, gold prices going through the roof. I think there is demand for platinum jewelry increasing. That's led to the platinum demand. And of course, both platinum and palladium demand is also increasing due to their automotive industry requirements, and there are supply constraints as well. So overall, it looks like the broad dollar weakness and the ongoing diversification of U.S. assets is also finding its way into some of these metals and perhaps the real assets as well. So that's the scenario as far as the dollar is concerned. As far as the rupee is concerned, we were still in that range between 40 and 60 broadly. There's very good demand on the dips, not only from importers, but also we saw some profit taking from investors in the stock market. FI number in the last 2 days has been around 1.5 billion negative. This is after tremendous inflow of about 50,000 crores that we saw post April 9 when the Trump tariffs went into a 90-day pause. And that I think 15% rally in the stock market from April 9 till last week, and I think no one could complain about some profit taking by the large investors, and that is what we are seeing, leading to some outflow, and also maybe bond market also giving some hints that there can be a broader risk off sentiment. So players playing it quite safe. Rupee definitely a good bottom near term at 85.40, and there is a strong overhead resistance technically at 85.75. Because 85.75 break, we could see 86, and but that requires a trigger from global markets some sort of a risk off event. So that's all. We look forward to the markets, currency markets being somewhat quieter, but all eyes will be on the bond market. Thank you.
Thank you, Jake. And I think, as you mentioned, the key narrative right now is the narrative of higher borrowing, which is building up, and hence the borrowing costs are also moving higher. And it's across the board, whether it's Japan, US, even Europe now with the Germany's debt breaks being off. So all of this is resulting in the bond yields moving higher, and there is a subdued risk sentiment also, which is prevailing. In the currencies front, we are seeing the dollar displaying a tendency to weaken. The narrative of reducing exposure to US assets are helping to keep the dollar weaker. Good rally in precious metals led by platinum and palladium. And for rupee, we are still in a range between 85.40 and 85.70. As JK mentioned, some profit taken by FIs after the rally in equities, and the resultant outflows have impacted the rupee trading weaker. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.